Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Friday, March 15th, 5:12 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Day of the market, still in an uptrend since the follow-through days way back, it seems, on November 1st and 2nd. A little bit of stress on the market this week. We'll talk about it as we get into the video. You can see the trend gauge over here. Market leaders still with the green arrow, but a yellow sub arrow as well. I've got a list of about a dozen leaders that broke the 21-day this week. The next support level down is the 10-week or the 50-day moving average. And we'll talk about the last time this type of breakdown happened and how it resolved as the video progresses. Short term, definitely yellow arrow, in fact, close to going to neutral as we had the NASDAQ 100 and the Dow join small caps below the 21-day moving average. All five of the indexes still above their 50-day medium-term moving average and the long-term 200-day moving average. So what happened today? Well, back on Tuesday, we had a nice strong move up in big caps and leaders, and that was the last time that leaders flashed any muscle. The last 3 days have been a pullback on the NASDAQ and the S&P 500. The one exception was a strong day for the Big Seven on Thursday, which really hid a bunch of deterioration under the surface. Now, not all is bad. There's still more good than bad, very clearly, and I'll lay out two scenarios shortly here. But all five indexes were lower for the week, and yields rose, and so did the dollar. We talked several times over the last 2 weeks about how the dollar and yields were oversold and should they reverse, and they reverse all the time. The question is, when this happens, how are stocks going to respond to it? And they responded the last 3 days by pulling back for the most part. So here are the numbers for the day. Big Seven down 1.27%, all seven of them lower for the day. RG8 not bad after getting really beat yesterday, still down 0.25%. S&P 500 opened down 0.55, closed just slightly below that, down 0.65. Equal weight only down 0.19, so that's a plus for breadth there. NASDAQ 100 down 1.2, equal weight down 0.85, Dow down 0.5%, and now a little bit of breadth improvement here. Mid-caps only down 0.09%, and the Russell 2000 was positive on the day. Global 60/40 down 0.31. Bonds basically flat on the day, so this was all equities. In-house GROTECTION down 0.53%. One offensive sell, two defensive sells. They were trims, not sells, just reducing the position. We'll talk about it when we get to the tail of the tape. Let's start with, there's a weekly chart of the S&P 500. We always on Friday like to be able to show kind of a split screen for the weekly and the daily so you can get some better perspective on where we are. And if you look at the weekly chart of the S&P, this is just like, no big deal. Big 2 days of 2 weeks of a pullback after all of these weeks up. Nothing to be concerned about. Well, true, maybe not true. It depends what direction the market is going to take. Is there going to just continue to be sector rotation while we go sideways here on the S&P? That's very healthy. Or is there going to be, for whatever reason, could be the Fed next week saying, well, now we've reduced our planned 3 rate cuts to 1 rate cut. That could cause things to go lower when the FOMC meets and announces their interest rate decision next Wednesday. So we're going to lay out that's one scenario where we would break down, and that would be similar to what happened last July. I talked about this precedent after this big, ugly Friday candle last week. I wanted to go on this week and see how was the follow-up action relative to what happened after this big move down on July 27th of 2023. The response was 1 day down and then a nice spike up on Tuesday, but then, back to back moves lower on the S&P, not doing significant damage, but breaking below the 8-day exponential moving average and closer to the 21 and 50-day moving average. than they've been since this inflection point where NVIDIA led a big AI tech gap up, and that was on February 22nd. If you watch the podcast, I broke this down a little bit more about what's lagging and what's not. And that's a good segue to the NASDAQ 100 because it is lagging. You can see how it has given up. Well, it's closed below the low of that gap up day. Wait a minute, this is a tech heavy index. Why should that happen? Well, because tech has been lagging. You can see for the last 2 weeks, the relative strength moving lower on the NASDAQ 100. Onto the Dow Jones Industrial Average. Just really chopping sideways. Looks like it's gone nowhere for about 5 weeks, frankly. Here's that 20-second move up, and we're back below the low of that week as well. And you can see how bad relative strength has been. Normally, we say relative strength, lack of relative strength in the Dow is okay because it's not tech heavy. Well, you can see it has flashed a bit of relative strength over the last week and a half, and that coincides with weakness in technology. On to mid caps. The mid cap index still looks fine. Second close below the 8 EMA, still above the 21 day. A little bit of relative weakness versus the big caps over the last week and a half. And then small caps closing below the 21 day, tried to rally back above it today, ran into the now rolled over 21-day moving average. And although it closed in the top of the range, couldn't make any progress there. Now, again, if you look at the weekly on this, doesn't look anything near like the progress and the nicer weekly trend up that we saw on the S&P 500. But anybody that's been following us in videos and this big flat base that small caps have been forming. If you zoom out, they obviously do have a lot more room to run if they want to, as they're still well off the highs, whereas the S&P 500 is near all-time highs. So that's a review of the 5 major indexes. Let's talk about these scenarios first of all. So the first one again, it looked like with Tuesday's move up that this 731 was off the table, but 3 days of a pullback on the S&P since then, and it certainly is firmly still on the table. In fact, we went 3 days after that, and then on the 4th day broke below the 8-day exponential moving average and closed on the 21 before starting this 3 waves down that lasted through from July through the end of October. The other scenario is back in early January here. After a nice run up, we saw heavy selling in tech the first couple of days in January. We pulled back. We righted ourselves, or at least stopped going down at the 21-day moving average. Flash to the NASDAQ, and you see the NASDAQ broke below the 21-day moving average. That's how heavy the selling was in tech. So the first bearish outcome would be a continued move down, break of the 21, like we saw last July. The bullish outcome would see us right ourselves next week down around this 21-day moving average, maybe pull back again and test it, and then start a move higher. I'm not going to predict either way. We never do. We know we've been reducing exposure the way our rules dictate as we've seen strength in leaders deteriorate. And that's where we stand now. So 2 scenarios for next week. The first one is a continued move lower after this, very similar to what happened in late July of last year, as this candle on 3/8 was similar to that, a topping candle after a big run up. We haven't exceeded the highs of that. We never did there back in July either. Or are we going to right ourselves back after a mild pullback, have money flow back into tech and carry us higher? And again, it's probably going to be the Fed decision on Wednesday that's going to dictate one way or the other the way this resolved, because really you can just very simply draw the lower high and higher low pennant over the last 2 weeks on the S&P 500. That's what we're seeing. And if you look at it on a daily chart, it's just very similar to this. So And then again, you could break below and it could be a fake out and you shoot higher in the other direction. That happens all the time. All right, off the 5 indexes, now let's go to some of the inter-asset correlation. The VIX, basically unchanged today. The dollar, a tight range, slightly positive on the day. This obviously has been impacting the precious metals. They're back in focus. Second tight day of a pullback for GLD. GDX, another tight range, basically closing flat. And SLV, silver, bottom of the range, but a gap up. Bitcoin was weak overnight, rallied during the day, closed just down slightly and holding right around the 8-day moving average. Now on to bonds. Bonds, very tight trading and basically unchanged today. There's the broad bond index. Here's TLT, basically unchanged there as well. The broad TYX 10-year just down slightly, and sorry, that's the 30-year, and the 10-year just barely up slightly. So no big deal in bonds there. All right, tail of the tape here. One thing that is, from a sentiment standpoint, a negative, the NAIM. This is investment managers. Their exposure went above 100% this week. This has corresponded with numerous tops in the S&P 500 in the past. So that's why we've got NAIM highlighted in red right here. As far as the indexes go, the stochastics are not in our favor right now. We're rolling over, but that happens from time to time as we pull back. The question is, does it turn into a deeper pullback or just a mild pullback? That's what we keep an eye on. A little bit of news, University of Michigan consumer sentiment slightly below expectations today. Wasn't really a big mover in the market. 3-day pullback after that big up day is the day count. First day back below the 8-day exponential moving average. 47 and 90 out of 91 of the past trading days above the 21-day moving average on the S&P 500, which is a pretty epic streak and really calls for a rest, frankly. If you just go by the historical numbers. On to sectors, oils, regional banks, and retail strong today. Tech weak, especially software, as Adobe, a big software player, was down significantly on earnings. Portfolio, we took our 22% gain on half of the NRGU position as it got extended to the upside. And then we trimmed our recent buys in Crowd and Uber, as with the market weakness continuing today. We down like about maybe 3, 4, 5% on very small, I'm sorry, down about 2 to 3% on small positions of this, either 2 or 3%, or 1.5 to 2% adds they were. So net, each one was down less than 0.1% of AUM. We're okay with paper cuts. We're not okay with massive wounds that need stitches. Bottom line, 4 of the 5 indexes red today, all 5 red for the week, while yields and the dollar rose this past week. So the 2 scenarios that I laid out, is it going to be late July or is it going to be early January? Might be the Fed that decides that for us on Wednesday. And let's get to some charts now. We trimmed CrowdStrike, CRWD. If I could type, you could see that. And you could see the big candle last week. That was the earnings gap up. Tight inside on the weekly standpoint and still above the 10-week moving average, but breaking and closing below the 21-day. After its earnings move up, we were using that as the drop dead with the position that we added after it pulled and bounced off of it, but taking a small loss on that one. And also on our recent add on Uber, we bought it when it broke Wednesday above this little resistance area by the 8-day exponential moving average, but then quickly sold off. It really has done what the market's done the last 3 days, and it broke below the 21-day moving average. Our remaining part of the position is going to be managed against the 10-week or 50-day moving average. And our GU with its gap up, knowing that it was coming to the top of this resistance area over here at that 563-ish, we took half of it off. You can see how many up weeks. This is basically NRGU is a 10% position in 10 big oil names, and it's now had 1, 2, 3, 4, 5, 6, 7, 8 straight up weeks. Uh, High oil prices are not good for the economy. They're inflationary, obviously. They hit the pocketbook and they hit producers that need petroleum products to do business. So it's something to obviously something to be invested in, which we are. We're overweight in oil names, and that's part of what the S&P 500 does is handle the sector rotation and from growth to value all the time, and that's why we use it as a foundation for our portfolios using leveraged ETFs. So those are the three trades. Let's review the rest of the portfolio. Bitcoin. Nothing wrong with that. Consolidating near all-time highs. You can say consolidating near all-time highs for everything that you own. You're in good shape. Nugget. This is gold stocks up 1.63% on the week, mild pullback today. And then along with our NRGU, those are the three leveraged sector ETFs that we own. IBIT isn't leverage, it's just straight Bitcoin. Let's see what else. Okay, NVIDIA. We trimmed some of this yesterday on a break of the 8. Was having a decent day today, sold off late. Closed slightly below the 8-day moving average, or basically right on it, you could argue, but making a series of lower highs. We love NVIDIA. We just would love to get more in on it. It pulls back to the 10-week there, and for taxable accounts, we hedge the gains instead of selling. CrowdStrike I already showed. Uber I already showed. All the remaining 4 positions. This is an oil stock. Weatherford continues to just trudge its way higher in a channel. Lilly pulled back a bit today, sitting right on the 21-day moving average. FCX. Copper continues to treat us well. Big breakout of the base and a follow-up today. And Nutanix continues to work on basically a 3 weeks tight-ish pattern. You can see on the weekly chart there. Any other major standouts that I want to bring up? We sold Palantir yesterday. That broke the 21-day today. We sold AMD yesterday. That rebounded and closed right on the 21-day today. And let's see, Ralph Lauren we trimmed just because it was making no progress, and that continues to go sideways above the 21. IoT was an earnings winner, undercut, failed breakout clearly, and then undercutting but holding the 21-day moving average there. That's going to wrap it. As always, like to hear from you. The email's don@revereasset.com, or leave a comment on our YouTube channel, which is getting infinitely more popular, and we're really happy to see that. If you're interested in becoming a client, email my partner, Dan Stewart, dan@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. Remember, our flagship portfolio is named GROTECTION because it serves a dual purpose: growing assets during uptrends and protecting them during downtrends. Let's take a look and see next week with the Fed decision which way we break out of this little triangle that we're forming on the S&P 500, and we'll go from there. Stay tuned. We've got the video reviewing the market every night here, and we appreciate your support. And with that, I'll wrap up the video for the week ending Friday, March 15th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening, and have a great day.